private credit in the market and how it's evolved, we see it as just an extension of the leveraged finance markets and the real estate financing markets, where you're moving from regulated institutions into private asset managers. And since 2008, there's been a growing trend for credit assets and investor bases, including pension funds, high net worth investors, and sovereign wealth funds, to invest in different assets with slightly more conservative return profiles. And that's where private credit has really taken off. So it's a confluence of looking for different assets that are still yielding more than, let's say, your very conservative bank lending markets, and the great financial crisis where more regulation was imposed on the banks, and that accelerated the need for a counterparty to really fill that void. In terms of the private credit market, we're representing both sides. We're representing the companies who are seeking that capital, and then we have a myriad of high-profile private credit asset managers that we're also representing. And many of those private credit asset managers that we represent are legacy private equity funds that then created their own private credit strategy. And so we're representing them to deploy the capital. We're representing some conventional private credit only shops, as well as certain regulated banks who now have a dedicated private credit strategy. The industry focus at Jones Day and our private credit strategy is fairly industry agnostic, although over the last 6 to 8 years, we've seen an acceleration of software businesses that we're working with, both on the investor private credit lender side, as well as the borrower capital user side, and digital infrastructure. So a lot of work is done here at Jones Day, where we're partnering our financial markets lawyers with our real estate practice and really working on data center transactions, financings for data centers, not just an equity position, but really coming at it from the credit side for any number of the marquee private credit and private equity institutions in the world. And we do this largely here in the US, out of London and the rest of continental Europe, as well as APAC. So we have a really robust financial markets and private credit practice out of Singapore, as well as several offices in Australia. Where we see the market in private credit, including the regulatory pressure that seems to be building as the Bank of England, the SEC, and other regulatory bodies from time to time indicate that there's concern that there's not enough visibility into valuations and the like for private credit. That will continue to be what I would view as ancillary concern over the asset class, but the asset class is not retracting. It's only going to continue to expand. The regulatory environment continues to be the regulatory environment in the US and Europe for regulated banks. There is still a growing need to deploy capital to help really grease the wheels of commerce around the globe, and private equity funds and private credit funds are working in tandem to help make that happen and really help build businesses across the world.